I've tried tons of different trading strategies, and after flip-flopping around, I settled on supply and demand and price action as my main edge. Even after having success, there was one fundamental problem that I found, and it's more than likely a problem that you're also having. This is episode 2 in my order flow series, and in this video, I'm going to identify that problem and show you how I use footprint charts to level up my trading. The market is always changing, and there's always someone online pushing some secret, special, holy grail method, and the fact of the matter is, the only thing that moves the market is order flow. You can be taught how to read a new indicator or how to trade ICT, but when it comes time to take the trade, now what? For me, that problem was conviction or confidence, because as we know, the market is never 100%. Now, I know I can't have perfection, but can I maybe avoid lower quality setups more often? That led me to a question, and that question was, how do I know that sellers will be selling where I'm shorting or buyers will be buying where I'm buying? How do I know to pass on a trade that will likely be stopped out on or press a trade harder that has a good chance to move further in my direction? That question led me to order flow and what is now my #1 order flow tool, which is called footprint charts. This will be an in-depth view into breaking down what footprints are, how you can read them, and how you can use them to confirm trades, and I'll be going over trades that I've taken and how I use footprint charts to confirm my analysis. And just so you know, the footprint software you're going to see in this lesson is called Motivewave. It's a more professional grade trading software, but there's a link in my description to a 14-day free trial on Motivewave's site so you can try it out for yourself. Now let's get into the lesson. Alright, let's get into footprint charts. Now in this video, I'm going to teach you what footprint charts are, and we're going to go over some trade examples to show you how you can confirm your setups using these footprint charts and order flow. So the first thing you need to know is that footprint charts allow us to see inside the candlestick and see what buying and selling is doing by price. You can see what's going on behind the scenes of the candlestick chart, what buyers or sellers are doing, how they are positioning, and who is leading, who is stronger. Now just to review, if you haven't watched my last video, I would suggest doing that. Now I'm just going to do a quick review from the last video. If you haven't watched that video, I would suggest to go do that now. But I'm going to repeat this because repetition is the mother of all skill, so you'll understand this is an area that people get confused on and is an area that I was confused on when I was first learning this. So you need to understand that a market buy order is an aggressive order hitting the ask. All right, this is at bid at ask for this column right here. This is market orders. This is your limit sellers right here in the red, and this is your limit buyers in the blue. All right, this 99 right here, that is a market buy. That is 99 market buy orders hitting a passive seller on the offer. All right, so if you are passively selling, if you have a limit order and you're limit selling, you're a passive participant, and if you're a limit buyer, you're a passive participant. And then if you are a market buyer, you are an aggressive buyer. And then if you're a market seller, you're an aggressive seller. These market sells hit the bid, and these market buys hit the ask. A market order fills a limit order. So a limit buy order is passive on the bid, limit sell is passive on the ask. There's always a buyer and seller for every transaction. In order for these 45 passive buyers to get filled, they would need aggressive market sellers to fill them. All right, and that's what this column indicates. This is the depth of market. We're going to go over this in another order flow series video. I'm going to dive into this in detail, so stay tuned for that. But I just want you to understand market orders and limit orders. All right, I have these color coded. If you need to pause the video to see, the green is buyers and the red is sellers. So this is going to be your first look at a footprint chart, which is in this right column here. This is a 5-minute candle that I pulled. This footprint chart is the exact same candle as this. I've tried to match up the bodies to be the same. That's the open, here's the close, and you have the wick and the wick. All right, the left side is the bid, and this is going to be sell orders. Right, a footprint chart is market orders. These are completed transactions. All right, market orders filling the limit orders. So the left side is the bid, and as we learned about, right, the bid is market sell and the right is market buy. So you have the bid, market sell orders, and you have the right side, which is market buy orders. Just looking at this, at the very top, there was 18 market buy orders and there were 0 market sell orders. There were 11 market sell orders down here and there were 0 market buy orders. That's the basics of it, and we're going to unpack this even further. Now what I use is a delta footprint. This is the main thing that I use and what we're going to look at on the trade examples. This is that footprint we just saw. This is the same footprint, but in a delta profile setting. This allows me to do a few things, but the volume is on the right, the total volume and the total delta. I'm gonna teach you what delta is right now. And then this shows a profile. Because it's a profile, just by viewing it, I can see the areas of lower volume and the areas of higher volume. And they're color-coded for the buying and the selling. So the profile helps me to see where the pockets of lower liquidity or higher liquidity are. So let's unpack this, all right? We have this 18 at the top, all right? Delta is simply ask volume minus bid volume. Here's ask and the bid. So it's 18 minus 0 to get a positive delta of 18. Remember, the 18 is buy orders. 18 minus 0 gives us plus 18. Moving down, ask volume minus bid volume. 118 minus 70, over here, 118 minus 70 gives us positive 48 right here. And then 95 minus 70 gives us positive 25. All right, simple math. And all this delta footprint is doing is basically doing the computation of this footprint automatically. Some people use these footprints, and there's ways you can trade this, but I'm focusing on a delta footprint. That's how I trade, but I focus on this. Now moving down to the bottom here, from the bottom up, we have, from this area right here, we have ask volume minus bid volume. 331 minus 222 gives us a delta of negative 109. Then 159 minus 146 gives us a negative delta of 13. And then again, negative 11, or 0 minus 11 gives us negative 11 delta. This is a finished auction. We want to see this at the lows and the highs. Lows and the highs on the day, not necessarily each candle, but if you have a bottom of the day or a top of the day, you want to see a finished auction where you have a 0 and 11. This is called a finished auction. But if it were different, if it were like this, 70, 118, like let's say this was the high, if there's not a 0 there, that means it's an unfinished auction. So how do we use footprint charts? All right, the footprint charts give you a look inside the market to see where aggressive participants are located. Aggressive participants can show follow-through, they can show defense, or they can become trapped. All right, in the first lesson, I talked about how order flow is a fluid term, and selling doesn't always mean that you sell. All right, selling can mean follow-through, and then it also can mean that those sellers are becoming trapped because you have a buyer and a seller for each transaction. If somebody is market selling aggressively, there are passive buyers filling those market sell orders, and if the passive buyers are too strong and there's too many of them bidding, then the market sellers will not be strong enough to move price down and they can become trapped. All right, we're going to talk about that. There are aggressive participants, but there's no follow through. That tells you that someone is preventing that side from winning, and any reversals will put that aggressive side in pain and force them to close. Where there is the most pain, there is the most gain. All right, thinking in institutions, you should know by now that retail traders tend to lose, institutions play games, market makers, all these things. What we're doing with the order flow is we're trying to identify where is retail going to trap themselves and be put in pain and get forced to close out and push price further up in the direction that we think it's going to go. So instead of trading with retail, we're looking to see where they're going to get trapped or where there can be follow through, where it's going to continue moving on, or where buyers are going to defend their position or sellers are going to defend their short entry. All right, so this is a footprint chart, and I'm going to go through some examples and explain it to you in further, but I'm going to try and put some charts on the right, candlestick charts, to play it in. You have the prices on the right here, so you can always pause the video and compare if you get confused. I have a 5-point range delta, so each one of these bars is 5 points. This is like 861. It's like 867 to 862 right here. Right, this one is 53 to 58. All right, so these are each 5-point ranges, 20-tick range chart. Now I want you to notice, we'll look at the candlestick chart. We had this selling at the open. We had the prior close, the prior week's close was a support level. So automatically we come down here, we start chopping around. So this is my pre-drawn support level. I'm trading off of support in this case. And we start to bounce at this. Now I'm looking for a way to confirm my entry. And is it going to break this support level and go lower, or is it going to move back up like it did? Now, before I know what's happening, I want you to see, we know that the red is essentially selling delta and then the blue is buying. Now, looking at the footprint in this area, I want you to notice at the low here. So as we're selling off, you have minus 98, minus 19, minus 103, minus 175, and then when we get to the low here at the support level, it really thickens up. Minus 700, minus 200, minus 500, minus 1,000, that's a big number. It really thickens up here. So when we're down here in this area, before the move comes up, you have to ask yourself, we're at support, and there's all this selling coming in, but it's not moving down. If there is so much selling, and the sellers are so strong, and they're market selling this thing aggressively, why is it not moving down? This is where order flow becomes creative. You have to be creative. You can't just be binary where you go, they're selling, I'm going to sell. They're buying, I'm going to buy. In this context, we're at a support level, and there's tons of selling. It should break and keep going lower. But for every transaction, there is a buyer and a seller. These market orders are getting filled by limit buy orders, passive buyers waiting on the bid. And if these sellers cannot break through those buyers, if the passive buyers are essentially absorbing all of this selling, then price will need to move up, right? We talked about in the first lesson that the market moves to the last seller sells. Once there are no more sellers aggressively selling and the limit buy orders remain, then the market will have to move up to facilitate trade. And that's what happened here. So if you can get your entry in here at 55 to 54, 56 with a stop at 53, right? You get in right here, 56, your stop's at 53. That's a 3-point risk based on this selling not going down this candle. Even if you got up here at 58, maybe you have a 6-point risk, but it goes up from 58 all the way to 74. Now I would have gotten out at the supply zone at the overnight high, which is about 68, 69. So that's still a 12 to 13 point gain on a 3 to 5 point risk, which is a really good risk to reward. But that is what I'm looking for in terms of context and the order flow, the delta, trap sellers. All right, now let's move to another example. Now here's what I do in the full-time trader room. I like to post a pre-market plan and what my thoughts are for the day, what I'm looking for. I'm Pacific Coast time, so the market opens at 6:30 my time. So this is before the market opens, and this is what it looks like. All right, this is a chart before the market opens. And I want to highlight this area that I was looking for buying into 59.90 to 6,000 range on any move under 6,000, but a hold at 59.90 I'll take long into 60.23. Now here's this range bottom, right? We have this big range right here. It bounces here. We're kind of balanced in this range going back and forth. And if we go under 6,000, but we can hold above 59.90, that's bullish for me. The buyers can keep this thing held. It's at the bottom of a range. I want to see buying and this move hold here. I'm looking for that before the market opens. Now here's the open. It sells off, breaks through this demand zone. It's looking pretty bearish, right? We come down, we break that 6,000 level, and then what happens? Above 59.90, it stops on a dime. Now, I can't stress enough how many times I've seen these moves come back up or stop right here and then just continue down, especially on bearish days, especially it hasn't hit 59.90 yet. On higher volume, this thing can totally just come back down and smash down. It's totally possible. So if someone's thinking like, oh, well, that green candle was entry. I mean, sure, but for me, I want to have a bit more confirmation to know, because I want to take high quality setups, because I've gotten in long and gotten smashed out to the long side or to the downside. And I want to know what's going on behind the scenes just to help confirm my entry so I'm more comfortable putting on risk. Or perhaps I want to up my size because there's really good confirmation. Obviously, this moved up. How can we confirm this trade using the footprint? And this is what the footprint looks like. So again, if you want to pause, here's 6,000, here's 59.90. 59.90 is down here, and then here's 6,000. So here's the initial break, and then here's what happened after. There's the break. So we're looking at the footprint in this zone right here. So it breaks down, we come down to this area. What happens at 59.95? Huge buying delta comes in. Now, what do you notice about the low here? If we look at the last example, we have tons of thick, heavy selling right here. They became trapped, it moved up. But here, there's not that much selling. So in this situation, I'm not really looking at sellers being trapped. And this is where context comes into play and how order flow is a fluid term, to where you don't need to have thick selling to convince you to buy. What this indicates here is a lack of interest on the selling. Very low numbers, right? We had some bigger numbers up here, minus 100. There really wasn't that much aggressive participants. And we have a completed auction, a finished auction right here, right? Minus 35 and 35 volume. So this is a completed auction. Not a lot of interest. And then you have this outlier in the data. The main thing I look for and can tell you to do is to look for outliers in the data. This is the strongest buying that we saw on the entire session so far. And then you get this big move up, all right? And I'm already looking for it to hold above 59.90 down here. This is the open. It comes down and it holds this area. Don't worry about this zero. That doesn't mean anything. That just means that there was equal selling and equal buying because there was 184 volume. If the volume was zero, that would be an outlier in data. So the 12-12 holds right here. So this large buying delta is defending. And then we get a move up. So my entry is in this 96 to 95 range. If I can hold with my stop down here at 92. So you're getting in at 95, 96. This is a 3 to 4 point stop. And this trade goes up about 15 points. Another solid risk and reward based off of the order flow. And I like these two examples because they have the same structure of this like V-shaped recovery, but the order flow looks completely different. And you have to just practice with it, practice watching it so you can interpret it the right way. Lack of interest, large buying comes in. This candle holds the buying right here, and this right here on this hold and this move up is my confirmation to take the trade long, targeting this high of day and getting your 15 points. Now here's another situation of trapped buyers on the other side. Just looking at a candlestick chart, not knowing what's going to happen. We come down, we bottom out, we start to move up. It's holding this area right here, right? Bull flagging, VWAPs up here, a good target for this thing to move up. And what happens next? Comes right back down. Now this is a trade that I took. How do you know what's going on here? Now you can make the case that this had trouble breaking. But again, if I'm going to put risk on and I'm going to put money on and risk my money to take trades, I want to know that I have a pretty good probability of winning that trade. Otherwise, I don't want to take it. I don't want to take a guess on this thing ends up smashing through and going to the upside when I'm short. So this is about 605, and then here's 696 down here, and then here's 605, and here's 696. This footprint right here is the one that we're going to look at. So when that was happening, when 605 was refusing to break, I got in at 1117, which this time is skewed, so don't worry about that. But I got in 1117 before this footprint closed. I was watching this 605 level. You can see it on the DOM right here. Heavy buying delta. This was like 200. And then I watched it in real time go to 500, and then 700, and then 1200, and then 1400, and then 1500. And that's when I got in. And I got in short because it was looking like this was going to trap buyers. And my stop is up here at 607. Again, a 2-point stop for potential risk. Now, I managed this trade wrong, and I wanted to put that in here because I got out at 605 and 6,000, and 6,000 was pretty much where people were going to place their stops, and I should have expected a stop run, which is what happened. So I could have got 8 points out of that trade, but I got 5. I can't remember what happened. I got out, but that was a mismanaged trade on my part. I wanted to put it in here because mistakes happen. In hindsight, this was a support level. Once this breaks, you can expect a stop out and a stop run to at least get my 8 points or more. And it even came back up to this level, and it did the same thing. Came to 605, heavy buying delta, never went above it, and then it came back down. So that was essentially 2 potential trade setups. But that's the trapped buyer. It's the same as the sellers. Huge buying delta comes in, outlier in the data. It can't break higher. I have a 2-point risk. Let's get in the trade short and take it down. Now let's look at another trapped seller as an example. All right, this is a trade I got in 808, which is about right here where this red dot is. I got in before this move happened up at 808 at 92.50. All right, I got in about right here before it moved up. What can we look at on the footprint chart to tell us to get in, that this is going to be a decent trade to the upside, that this isn't going to pop up like it did right here and then come back down, or if it's not going to break the low and go lower. So here's the footprint chart. Now this was happening for quite a while. This footprint opened up at 711, and then this one was for about an hour, because remember this is a 5-point range. So this is from like 92.5 up to 95.25. So this whole area right here to right here, this entire section that I'm circling right now, this entire section of trade is this 1 footprint candle, all right? Because it does not print a new candle until a 5-point range breaks. So this went from 90 to 95, this new candle opened. This went from 94 to, or this went from 94 to 99.50, and then this new candle opened, right? That's a 5-point range, 20 tick range chart or footprint chart. Here's the footprint in that in this circled area. I'm watching all this selling just from the lows, just coming in, heavy, thick selling, and it's not moving lower. And looking at the chart, it just looks like it wants to go back up in that sense, the structure-wise, but I got in at 92.50, which was about right here. Now, I remember this was a speculative trade. I got in at 92.50 with my stop at 90, so it's a two and a quarter risk trade, speculating that these sellers will become trapped and that we will move up. And that's exactly what happened. It came here, I didn't get out, it came back down. I'm comfy down here with my entry, and then it moved back up, and I got out in this area towards the supply zone. Tons of selling, no follow through. It moves up, sellers become trapped, and then you get to move up. Now let's look at a example of acceptance in terms of how we can spot to get in a trade that's going to continue up higher and accept higher prices. So I got in this trade at 59.32, which is right here. All right, so before this overnight high broke, 10.38, I got in this trade and I took it up. Now you can say an overnight high breaks out and it's going to move up. That's fine, but I've been in a lot of trades where the overnight high fails. In fact, when we get to highs, I'm always looking to fade it. But in this situation, I did something different. Instead of fading the highs like I normally look for, I bought with them. What are we seeing on the footprint chart? Here's 33.75. Here is 33.75, about right here, 146. So we have this consolidation range on these footprints, and then mostly during this footprint is what we're looking at. Now I got in at 32.25. I'm watching this, I'm looking at it's looking bullish already. Then this footprint opens, and I see tons of buying delta right here come in. I'm watching it go up. It's going from 500 to 1,000 to 2,000 to 3,000. These are the biggest numbers that we've seen yet in this slide deck, right? It's got 4,000 at this 59.30 and moves up here to 32.25, right? It's no coincidence that my entry is right about here because I saw this one come in. Now we have buying right here and we have strong buying right here. I watched this in real time, again, go from 2,000 to 3,000, and now I'm getting in long, speculating that it's going to break this overnight high and it's going to move up. And then, of course, I get in, and then this moved up, and I believe I got like 8 points on that. I didn't put my sell, but I got out up here at like 40-something. So I got my, 8 to 10 points on this trade. The difference between the trapped buyers and buyers accepting is you have a large number, and this did not move up. It stayed here, and this moved back down. With this acceptance, we have buying. This comes up. You have strong buying. It moves up again, and then even stronger buying, and it continues to move up. That's the difference between buyers locking out the sellers, absorbing any selling action up here, and then moving the price up higher. And I wanted to put these examples on here so you can see how two similar data readings can produce different results. All right, now if this 42.35 never went above this level and this footprint closed red down here, then I would likely have been looking to short it. But because we had strong buying come in and then strong buying come in again, my entry is at 32.50, pretty much with this delta. It's no coincidence. It's because I saw that buyers are probably going to break through this overnight high and continue price up. And that's exactly what happened. They broke the high, and then it kept going up. And that was a successful trade. So let me know what you guys think in the comments. If you have any questions about this, I hope I explained it clearly. I can make more videos on it. The next video is going to be on Bookmap, and we're going to go into the depth of market. And then if you guys want, when I'm done with the order flow series, I can maybe just post some live trades and post some more like setups to explain things better. That's it for this one. Alright, so that was footprint charts. If you learned something, drop a thumbs up. And if you're new to my channel, I'd appreciate you subscribing so I can continue to make the next videos in this series and provide value to those who are watching. The next video is going to go over the heat map or book map, which shows the same information but in a little different way so you can catch something that you might not directly see on a footprint or candlestick chart. If you have any questions or comments, let me know down below and I will reply to you. Thanks for watching, and I will see you all in episode 3.